I have sat across from more than 2,000 people in this chair. 2,000. I want you to think about that number. 2,000 retirements. 2,000 conversations that started with someone walking through my door, sitting down and telling me they thought they were ready. And here is what I learned. The people who are genuinely comfortable in retirement, the ones living without financial anxiety, without waking up at 3 in the morning wondering if the money will last, they are not the people who earned the most. They are the people who knew one thing that the others didn't. One secret. One idea so simple it sounds almost insulting when I say it out loud. And yet I watched brilliant, hard-working, disciplined people, engineers, doctors, professors, business owners, destroy their retirements because they never learned it. My name is Dr. Richard Ashford. I'm 70 years old. I spent 35 years as an economist and retirement planning specialist. I have a doctorate from Georgetown. I published research on pension sustainability. I lectured to auditoriums full of financial professionals. My colleagues called me the retirement architect. And unlike most experts who tell people how to manage money without following their own advice, I practiced what I preached. I built my own portfolio with discipline. I followed every rule I ever gave a client, and they worked. I retired at 65 with genuine financial security. My health is managed. My income is structured. I sleep well. But what keeps me from sleeping through the night sometimes is something else entirely. For every client I helped cross the line into a secure retirement, I watched 3 others walk out of my office, ignore what I told them, and unravel everything they'd built. People with every resource, every piece of correct information, and still they got it wrong. I kept a notebook for 20 years. Every client who lost their retirement, I wrote down what went wrong. After 2,000 entries, that notebook revealed one thing I didn't expect. Not bad luck. Not bad timing. One mistake. The same mistake, wearing different faces. Today I'm going to tell you what it is, and I'm going to tell you about Frank, the story I think about whenever I want to ignore a financial review. Stay with me. This is the same conversation I wish Frank had listened to. Here is the pattern I identified. I saw it in my very first decade as a practitioner, and I never stopped seeing it. The mistake that repeats, generation after generation, client after client, regardless of income level, education, or how carefully someone saved. Most people treat retirement as a savings event. They pour into a 401k, build home equity, fund an IRA when they can, and assume that when they reach a certain number, they're done. They work toward that figure the way someone packs a bag for a very long trip. You keep filling it until it feels heavy enough to go. And then they go. And within 3 to 5 years, sometimes sooner, it starts to feel lighter than expected. Here's the thing. They built a pile of money. What they did not build was an income system. And that distinction between a pile and a system is the entire difference between a retirement that works and one that doesn't. A pile of money shrinks. Every month you draw from it, it gets smaller. Every medical bill, every property tax, every trip to see the grandchildren, the pile reduces. And anxious retirees make catastrophic decisions. They sell equities at market bottoms. They chase yield. They move everything to cash and watch inflation eat it silently. An income system generates. It produces cash flow from multiple sources, month after month, while the underlying assets ideally grow. You are not spending the pile. You are living off what the pile produces. The wealthy retirees I advised, people living comfortably on $80,000 or $100,000 a year without a trace of financial fear, their secret was never the size of their pile. It was the architecture of their income. Social Security optimized for maximum lifetime value, dividends from a diversified portfolio, a rental or structured annuity, Roth accounts timed for tax-free withdrawals in high-expense years, required minimum distributions planned years in advance. These people didn't retire hoping their money would last. They retired knowing their income would flow. That gap between hope and engineering is the secret. And the failure to understand it is the pattern I saw destroy retirement after retirement after retirement. Which brings me finally to Frank. Frank walks into my office. It's 2009. He's 61 years old. He's carrying a coffee in one hand and a manila folder in the other. He sets the folder on my desk with the quiet confidence of a man who has done his homework and knows the numbers are on his side. He's smiling. He has absolutely no idea what is about to happen to his financial future. Frank was a senior project manager for a construction firm in Columbus, Ohio. 28 years with the same company. Steady, methodical, reliable. He had $480,000 in his 401k, owned his home outright at $315,000, and carried no debt. He and his wife were in good health. On paper, Frank was not in trouble. But inside that manila folder was a plan he'd been quietly assembling in his head for a decade. And the moment I read it, I saw the problem. Frank was planning to retire into a pile. His strategy was simple. Draw from the 401k as needed. Claim Social Security at 62 to fill the gap. Sell the house later if things got tight. It was the plan of a man who thought entirely in terms of resources, and not at all in terms of income flow. "Frank," I said, "what is your projected monthly income in retirement?" He looked at me. He didn't have an immediate answer. "Your Social Security benefit at 62 will be approximately $1,510 a month," I told him. "That's the permanently reduced benefit for claiming 8 years before the optimal age. If you wait until 70, that number becomes roughly $2,940 a month. That's a difference of $17,160 every single year for the rest of your life. And unlike your savings, it's guaranteed, inflation-adjusted income." He shifted in his chair. "And your 401k, if you need $4,000 a month from it, which is roughly what your current lifestyle costs above Social Security, you're looking at a withdrawal rate close to 5% annually. That's above the sustainable threshold. With market volatility, you're likely to deplete that account by your mid-70s. And every dollar you pull is a taxable distribution that could push you into a higher bracket, trigger Medicare surcharges you're not accounting for, and reduce the compounding potential of what remains." Frank looked at me the way people look at a doctor who just described a symptom they recognize. "But I have almost $500,000, he said quietly. "You have a pile," I said. "You don't have a system." I can still see his face in that moment, the jaw tightening, the eyes moving to the folder on the desk, the folder he'd been so proud of. That look. I've seen it hundreds of times. It never gets easier to witness. I laid out a different path. Work 2 more years. Use that window to execute a Roth conversion strategy, moving money from the traditional 401k into a Roth IRA at a lower tax rate before income dropped unpredictably. Wait until 67 for Social Security, not 62. Build a dividend-producing position inside the portfolio. With those adjustments, he could retire with an income system rather than a savings pile, and the difference would be felt not in year 1, but in year 12. Frank thanked me. He said he'd think about it. He didn't come back. I found out what happened to Frank 4 years later through a phone call I still think about. His wife called my office. She'd gotten my number through a mutual colleague. She spoke carefully, the measured precision of someone who has rehearsed a painful story just to get through it without breaking down. Frank had retired at 62, exactly as planned. He'd claimed Social Security immediately. He began drawing from the 401k at a rate higher than projected because their actual monthly expenses, groceries, utilities, car insurance, property taxes, were running about $600 more than Frank's estimates. Inflation had done what inflation always does. By late 2012, the 401k was down to $287,000. Frank, rattled by the market volatility of that year, moved everything into a money market fund. He didn't want to lose what was left. What he didn't understand was that he'd already lost the most irreplaceable thing: time in the market. The money sat. It earned almost nothing, and they kept drawing from it every month. Then the medical bills arrived. His wife was diagnosed with a serious autoimmune condition in 2013. Even with Medicare Parts A and B and a supplemental Medigap plan, the out-of-pocket costs, specialist visits outside the network, prescription medications not covered under Part D, physical therapy, ran between $800 and $1,400 a month for 2 years straight. By 2015, the 401k held $138,000. Frank sold the house. It had appreciated, worth $340,000 by then after the post-recession recovery. After closing costs and capital gains, they cleared about $305,000. They moved into a smaller rental apartment. He deposited the proceeds into a savings account. He was too frightened to invest. He didn't trust himself to make the right call. So he did the safest thing he knew and watched inflation consume the purchasing power, month by month, dollar by dollar. When his wife called me, Frank was 69. He had roughly $390,000 in total: cash, savings, house proceeds, but no income system. Just a pile that had been shrinking for 7 years. They were renting, no equity. And the Social Security he'd claimed at 62 was still $1,510 a month. That number, locked in forever, would never be what it could have been. She didn't call me to fix it. It was too late for fixing. She called me to understand, to know how a man who worked 28 years and saved diligently could arrive at nearly 70 with a pile that was running out. I told her the truth. Frank had resources. Frank never had a system. And when the hard years came, the system he hadn't built had no answers. She thanked me. She hung up, and I sat at my desk for a long time. That is the weight of this work, not the economics. I can handle the economics. It's the voices on the other end of the line, trying to understand how it all went wrong when they did so much right. I'm not telling you Frank's story to frighten you. I'm telling you because Frank is not an outlier. Frank is the pattern. Frank is the version of this story I've watched play out with different names and different numbers in different cities across 35 years of practice. And every single time, the root cause is the same: a pile, no system. You can choose differently, but only if you act while there is still time to build the architecture. So here is what the wealthy retirees did. Here is the secret, translated into 5 specific actionable steps, backed by 35 years of evidence. Step 1. Stop counting your pile. Start designing your income streams. Before you retire, ideally 5 to 10 years before, answer one question with precision. Where will my monthly income come from? In what amounts? From how many independent sources? Write it down. Social Security at a specific age. Dividends from a specific portfolio. A rental, an annuity, a consulting arrangement. The answer cannot be, I'll draw from savings. That is a pile strategy. Income systems thinking changes every financial decision you make from this moment forward. Step 2. Treat your Social Security claiming decision as the most consequential choice of your final working years. Every year you delay beyond 62 adds 6 to 8% to your annual benefit. From 62 to 70, that is a 64% increase, guaranteed, inflation adjusted, for life. Frank took $1,510 a month when disciplined planning could have given him $2,940. Over a 20-year retirement, the gap exceeds $340,000. And because a larger guaranteed income stream reduces pressure on the portfolio, everything else in your retirement math improves with it. Step 3. Execute Roth conversions in the gap between retirement and Social Security. If you retire before claiming Social Security, your income drops. And that drop creates a window to convert money from pre-tax 401k or IRA accounts into a tax-free Roth IRA at a lower rate than you paid while working, and potentially lower than the rate you'll face when required minimum distributions begin at 73. I executed this for dozens of clients. For some, it saved $40,000 or more in lifetime taxes. Step 4. Build a cash buffer against sequence of returns risk. If the market drops 30% in your first 3 years of retirement, and I watched it happen in 2000, 2008, and 2020, and you are drawing from that portfolio simultaneously, you will sell assets at their worst moment and permanently impair recovery. The protection is simple: 1 to 2 years of living expenses in liquid, stable accounts, drawn from during downturns while the investment portfolio recovers. Step 5. Plan healthcare as a certainty, not a possibility. Medicare doesn't cover everything. Long-term care isn't covered at all. The average American couple retiring today will spend between $300,000 and $400,000 on health care over their retirement. Frank's wife's medical costs consume more than 20% of his remaining assets in under 2 years. If you don't plan for it with the same seriousness as housing, you're leaving the largest budget variable entirely to chance. These 5 steps are not exotic. Any competent financial professional could explain them to you. The real secret is that wealthy retirees actually implement them years before they retire, with discipline and intention. The rest wait. They improvise. They tell themselves they'll figure it out when the time comes. The time always comes before they're ready. I am 70 years old. My retirement works because I followed these rules, not because I was smarter than my clients or had advantages they didn't. Because I built the architecture early, maintained it faithfully, and never mistook hope for engineering. I still do this at 70 because I carry Frank's story. And every person who hears this and decides to build an income system instead of just a pile, that is one less phone call from a spouse trying to understand how it all went wrong. Don't be a cautionary tale. Build the system. Start today.